Hello, this is Dr. Nunez. Welcome to the Chapter 24 lecture. In Chapter 24, we are looking at evaluating decentralized operations. In a centralized company, all of the major planning and operating decisions are made by top management. So everything flows from the top down in a centralized company. But on the other hand, in a decentralized company, what you have is the planning and the operating decisions are spread out. So you have managers of separate divisions or units that are delegated operating responsibility. Now, the amount of decentralization that you'll see in companies is going to depend on the company's unique circumstances. Managers of decentralized operations typically will work a lot more closely with customers. And the division unit managers in decentralized operations typically are responsible for the planning and controlling of their respective divisions. And you have divisions that often are structured around, products and customers and regions. So our real focus in this chapter is on those decentralized operations. So some of the key advantages, the reasons why we have companies that are characterized by decentralized operations is because it puts those managers closest to the decisions. And it gives managers more training. They have more opportunities for training, and it allows them to gain the expertise that they need in certain areas of operation. And typically, it will lead to greater retention of managers. When you have centralization and all the decisions are made at the top, it's very hard to hold on to managers because they feel like they're not engaged, they're not participating, and so they will typically move on. They will leave a lot faster in centralized operations than they will in decentralized operations. And you get a little bit more creativity, and you have, again, better customer relations when you have decentralized operations. But unfortunately, some of the disadvantages are is sometimes you can see negative effects on profits because sometimes you have managers that are making decisions that will enhance them personally as opposed to decisions that will enhance the company. Sometimes. So that is a potential disadvantage. And sometimes you get that duplication of assets, duplication of expenses because you have things spread out so much. So let's talk about what's important to us from a decentralization perspective. When you have a decentralized business, you've got managers that are responsible for certain areas, and we call those responsibility centers. And we practice responsibility accounting for responsibility centers. That means that we're going to measure and report operating data by responsibility center. Typically, there are three types of responsibility centers that we look at. Cost centers. Those are managers that typically have responsibility over costs. That's it. They have no revenue responsibility. They have no profit responsibility. They are only responsible for costs. So, for example, you might see something like a manufacturing plant. There's no sales activity in a manufacturing plant. They only produce products. So they only have costs. They have manufacturing costs. They have materials, labor, and overhead. They don't have anything else. So you could have a plant manager in that situation that is managing that facility as a cost center. They are only responsible for costs. But then you can also have profit centers. That means that you've got managers that have responsibility over both revenues and costs. So, for example, you may have a business unit, and in that business unit, you've got the sales function, so you have revenue responsibility, and you've got manufacturing plants, so you've got cost centers. So you have both revenues and costs, and hence you have profit responsibility. And then the next type of responsibility center that we see is investment centers. That means that you have responsibility over revenues, costs, and investment in assets. And there are a variety of ways of measuring performance. Typically, when we just have a cost center, we will do something like what we did in chapter 23, a variance analysis. We'll look at variance analysis for the cost the manager is responsible for, so that we can measure performance and understand what happened. And when we have a profit center, we probably will still look at, variance analysis so that we can understand costs, but we'll probably also extend that to the income statement, because profits are measured on the income statement. So we'll want to look at an income statement and analyze the income statement. And in this case, we have divisional income statements. So, we have a company that's decentralized, and these profit centers, if you will, are managed by division. So you have the theme park division and the movie production division, and you have the revenue responsibility, and you have the cost responsibility, and ultimately responsibility for the profits. So you've got profit centers, and you want to be able to report on their performance as a profit center. And notice we have basic revenue and operating expenses. So we have the income that is before any the support department allocations. And we looked earlier, I think it was chapter 19, at support department allocations. Those costs do have to be allocated to these decentralized departments, so that when we measure performance, we're measuring performance on that bottom line, that true bottom line, the true operating income for the division, that includes all costs that they have some control over. When we look at investment centers, that adds a level of complexity, because with an investment center, we are responsible for revenues, expenses, the profit, as well as the investment in assets. So we have to measure performance and include that investment in the asset base. And there are several measures that we can look at to measure an investment center performance. We still would probably look at, a basic variance analysis. We would look at the divisional income statements like we saw on the previous slide. And we would also add in typically divisional or regional comparisons. So when you're looking at an income statement comparison, you want to be able to compare sister divisions over a period of time. So in this case, from December for the year ended December 31, we want to be able to compare these three divisions and their relative performance from an operating income perspective. So we have the basic measures of, revenues and expenses, got those support department allocations in there, and we're measuring ultimately the performance on that income. So we do want to be able to measure over a period of time, kind of a horizontal analysis, if you will, for these sister divisions. That's one aspect of measuring the performance. But in addition to that, we also have to be able to build in that investment in assets so that we can measure performance on that investment. And one of the most common measures that we use to measure investment center performance is what we call the return on investment. It's a basic financial ratio that typically is introduced in financial accounting, and we use it to measure an investment center's performance. The basic calculation of this return on investment that we usually just refer to as ROI, it's just income over assets. So we're looking at operating income, so not net income, right? It's not that income after taxes. It's the operating income, so the income generated from operations over the investment base, that investment in assets for the investment center. And obviously, the higher the better, right? We want to be able to max out. So more is always better with return on investment. And intuitively, what this measures is the ability to use those assets to generate income. So really what we're saying is, given an investment in assets, so given a dollar investment in assets, what are we getting in operating income? And that's what the return on investment tells us, how much we're getting in terms of operating income given an investment in assets. So in this example, with these three sister divisions, Northern, Central, and Southern, we have the ROI, the return on investment. So 20%, 12%, and 15%. So interpretation. So what this tells us for the Northern division is, given a dollar investment in assets, we're generating a 20% return for the Northern division. So 20 cents on the dollar. For every dollar invested in assets in the Northern division, we're getting a 20% return, or 20 cents in operating income. And for the Central division, given a dollar invested in assets, we're only getting 12%. And for the Southern division, given a dollar invested in assets, we're only getting 15%. So again, kind of a horizontal comparison. We can compare these three divisions, these three sister divisions. And one of the good things about this ROI measure is that it is a relative measure. It's not an absolute dollar measure. Sometimes it's difficult to compare across divisions or across investment centers when you use absolute dollars, because the numbers can be skewed based on size. A larger division or a larger investment center probably will have a larger return on investment, right? That doesn't necessarily mean that it's better. It could just mean that it's bigger. But when we use more relative measures, instead of just looking at, absolute dollars, instead of just looking at operating income, for example, when we look at a more relative measure like return on investment, it's a lot easier to compare, because the relative measures, a percentage, is not skewed by the size, and it gives us more information, relatively speaking, when we make comparisons. So again, that's a good thing about this ROI measure, the relative percentage that we get. And again, it tells us how well we are using these invested assets to generate our operating income. Now, one of the things that we also like to do to add more value to this return on investment is use the DuPont formula to calculate ROI. What the DuPont formula does is it breaks the ROI down into two key components. And the two key components of the DuPont formula are the profit margin and the investment turnover. So what we're saying is, instead of just the basic calculation, which is operating income over invested assets, we split it up and we measure first the profit margin, which is operating income over sales. And then we measure the investment turnover, which is sales over invested assets. So notice all we really did here was add in sales. So the measure on the previous slide, right, the return on investment on the previous slide was the operating income over the invested assets. But now when we slide in sales, we use it as the denominator here, and that gives us a profit margin. It tells us how well we use our sales to generate operating income. And then when we add sales here to the numerator, it tells us how well we use our invested assets to generate our sales, or to turn over those assets into sales, hence an investment turnover. And when we put these two together, when we multiply the profit margin times the investment turnover, we get ROI. So we get the same measure that we got on the previous page. It's just now we have two pieces of information to help us understand the ROI, instead of just one piece of information to understand the ROI. So the calculations. So earlier we saw that the Northern Division had an ROI of 20%, Central Division had 12%, and the Southern Division had 15%. But now we have more information, in that we know the Northern Division has a profit margin of 12.5%. So given a dollar in sales, they're able to convert that dollar in sales into a 12.5% profit margin, or 12 and a half cents on a dollar of sales, right? Every sales dollar yields 12.5 cents of operating income. That's what the profit margin tells us, right? The percent of each sales dollar that ends up being operating income. And the investment turnover tells us how well we use those invested assets to turn them into sales. So given a dollar invested in assets, we get 1.6 in sales for the Northern Division. So again, the DuPont formula tells us what those two key ingredients are in the ROI calculation. So we know why the Northern Division is performing better than Central and Southern. The Northern is better than Central and Southern primarily because of what they're doing here. So they are superior in terms of the investment turnover, their ability to turn those invested assets into sales. Again, for every dollar invested in assets, they get 1.6 in sales. That's better than the Central Division. That's better than the Southern Division. And they're actually doing a pretty good job on the profit margin, right? For every dollar in sales, they're generating 12.5% in operating income. That's as good as Central and considerably better than Southern. Put these two together, and that's why this looks so good. And then the other end of the spectrum, why does Central look so bad? Why is Central only generating an ROI of 12%? Well, the problem is right here. The bigger problem for Central is they're just not able to turn those assets into enough sales dollars. For every dollar they invested in assets, they're getting less than that in sales. They're only getting 0.96 in sales, right? Poor performance versus the Southern Division and the Northern Division. So these two components tell us more about this ROI. It's only 12% because this is really not very good. This is where they need improvement. Now this is good. They're doing a good job with the profit margin, but this is really hampering them in terms of their ROI performance. And then when we look at the Southern Division, well, they're really suffering with profit margin. They're just not generating enough profits. So given a dollar in sales, they're only getting 10 cents or 10% in operating income, not performing nearly as well as the other two divisions. And the investment turnover is just not as good as Northern. It certainly is better than Central, but it's not as good as Northern. So the DuPont formula really gives us more information, and it helps us understand this ROI calculation a lot better because we get these two key components. These are the two key ingredients to generating a return on investment. Now, the other measure that some firms will look at, in addition to the return on investment, is residual income. So some of the disadvantages of the return on investment is that, sometimes you have managers that are confused about what they should focus on. So if you want to improve your ROI, what should you focus on? Should you focus on profit margin or should you focus on the investment turnover? Sometimes managers aren't sure which one they should really be focusing on and which one they should be maximizing if they want to maximize the ROI. But sometimes also they're too focused on the number, just generating a certain number and not necessarily growing the business and making it more valuable and more profitable. So the residual income measure is sometimes used in addition to the ROI, and it gets around some of those disadvantages because the focus is not on managing to a percentage. The focus is on generating additional income. So what residual means, the excess or what's left over. So the purpose of the residual income measure is to measure the additional or the excess income that is generated by the business. And what we mean by excess is there's some minimum, and we want to look at the operating income in excess of that minimum that is required. So if we were to use this residual income measure, and it's a very simple calculation, it is the operating income minus some minimum return gives us that residual or that excess. So for these three divisions, if we calculate the residual income, so we have the basic operating income, and then the minimum return that is required by this company is 10%, 10% on the assets. So 10% on the assets for Northern is 35,000, which means they have an excess or a residual income of 35,000. Central Division has an excess of 14,000, and Southern has an excess of 25,000. Now, again, we are measuring the excess income. That's what residual income measures. It measures that excess over the minimum acceptable operating income. And you want to be careful when you compare absolute dollars. You want to make sure that you have comparisons that are of appropriate size, similar size. You don't want to compare a very large division with a very small division, because again, sometimes absolute dollars can be skewed based on size. You don't want to be able to measure income and say it's good. Well, it could be good again just because it's bigger, not because it's better. So when you make comparisons using residual income, you want to make sure you're comparing of the same approximate size. And for example, when we look at this residual income, it does allow us at least to make decisions that might be in the best interest of the company, not necessarily decisions that are in the best interest for the manager. So, for example, if you have a manager who's responsible for a business and they have a current return on investment of 20%, and they're considering a new project, and the new project has an ROI of 14%. Well, this is a situation where you could have a manager that says, I don't want to do that. I don't want to invest in this project that only has a 14% return because it's going to pull down my current return. If I've got a current return of 20% and I layer in a new project that only has a 14% return, it's going to pull my ROI down, and it's going to be something less than 20%. So they might hesitate to invest in this project, even though it exceeds the company's minimum return. So the company has a minimum return of 10%, which means anything over 10% is a good project. Anything over 10% is going to contribute residual income. But if you just measure using return on investment, you have a manager that again might say no because 14% is less than 20%. But if you're also measuring that manager's performance based on the ROI measure, for example, they might be more inclined to accept it because it's a project that would generate ROI, positive ROI, because it exceeds the minimum acceptable return. So if you have a compensation package that's based on both ROI and residual income, the RI measure, then you might have a manager that's more likely to accept projects that exceed the minimum required return, even if they're less than the current return on investment. So that's a little bit on performance evaluation for these investment centers. That's our focus in this chapter, and I will see you in the problem solving session for chapter 24.